All right. So now we will talk about two, three different types of revenue arrangement is what we commonly see. And one of them is principal and agent relationship. So the question is that are you the principal or are you the agent, right? And why this question is important? This question is important because if you're a principal, you get to record the gross revenue. Now, if you are the agent, then you are only allowed to record the commission is what you make as an agent in that arrangement. So the extent of revenue which you need to record, it may not have an impact on your profitability, whether you are a principal or an agent, but it certainly has a big impact on your top line, right? That how much revenue you are allowed to record, then what are your gross margin ratios, what are your EBITDA percentage, and all of that gets impacted depending upon whether you are a principal or an agent in a particular arrangement. And then similarly, what we see is that, in a consignment arrangement, that whether you are a consigner or a consignee, and why is that important? Because that, in a way, is this a consignment sale or is it an actual sale? Because that determines the timing of the revenue recognition, right? When is it you need to record the revenue, right? And then, there are some arrangement where you actually received an advance from the customer, right? So the question is, if I have received money from the customer, is it really an advance or do I need to record revenue? Is it a deferred revenue? Is it an actual revenue? When do you record revenue, right? So some of these arrangement is what we will try and discuss, and we'll try and understand this with the help of few examples as well. So the first is on principal versus agent, right? Now determining whether an entity acts as a principal or an agent in a specific arrangement that affects the amount of revenue to be recognized, which is gross versus net, right? That's what we need to figure out, that do I need to record revenue on a gross basis or do I need to record revenue on a net basis? A principal in a way provides goods or services itself, whereas an agent is actually arranging for another party to provide the goods or services. So how do you distinguish between the principal and the agent? An entity is a principal if the entity controls a promised goods or services, right? In that arrangement, if you controls a promised goods or services before it's a transfer to a customer, it may not be a principal if it obtains legal title only momentarily before it is transferred to a customer. So, and we will try, and again, the standard actually gives three criterias, right? Which is to say, who is the primary obliger? Do I have the inventory risk, from the customer standpoint perspective? And do I have the latitude in a way in terms of pricing, right? So we will try and understand all of these three criterias from that perspective. So what are these three? Entity is primarily responsible for fulfilling the promise. Who is responsible for fulfillment of the promise? Entity has the inventory risk. Entity has the discretion and establishes prices. So who has the ability to determine the pricing? Who has the inventory risk? And who is responsible for fulfillment of performance obligation, right? Are you, as the contracting party, are you the one responsible for fulfillment of performance obligation, or another party is actually responsible for fulfillment of performance obligation, right? And this, all three is, again, this is an area of judgment. Many a time this is simple. Many a times this is simple, vanilla. You will know I am an agent or I am a principal. For example, if you are, an agent which is only selling tickets on behalf of somebody, right? Like an airline agent, for example, right? We see several examples of a lot of these aggregators or marketplace arrangement, what we see very commonly, right? Then, of course, we see people like who sell insurance policies, right? Or other things on which are selling on behalf of others, right? So they're not like, then there is a distinction you need to make, that if I am a reseller, so to say, right? And when you think about a reseller, am I taking a risk and reward of the ownership of that product, right? And you saw the thing that, am I now the principal? Am I taking the responsibility, the risk and reward? And then I'm selling, determining at what price point. If I'm unable to sell, right? I will be taking actually the inventory risk. In a way, I may suffer a loss if I'm not able to resell this product, to another customer. And let's say many times you have, let's say, these resellers, let's say, of these car dealers, right? So the question is a car dealer is a principal or an agent? Okay, and it depends upon to say, is the car dealer is actually taking the inventory risk? Is a car dealer is going to decide the pricing? Is a car dealer is primarily responsible for fulfillment of performance obligation? So you got to look at all of this for you to, again, and there is no criteria we suggest that, this is more important versus this and versus this. So all three are important. There may be that situation that one, let's say in services arrangement, the inventory may not be there, right? But the whole question is, if the customer is not going to buy, am I going to suffer the losses because I have made arrangement to provide these services, so on and so forth. So we got to evaluate, right? So the specified goods and services and the manner of transfer of control are required to be identified in the context to say that who is primarily going to be responsible, who has the inventory risk, and who has the ability to establish the prices, from that perspective. So let's try and look at this again. We will try and understand this with the help of an example. So if you're a principal, you end up recording revenue on a gross basis. If you're an agent, you record revenue on a net basis. That's where this distinction in a way becomes very, very important. And when you record revenue, when you want to transfer the goods or services to the customer, if you're a principal, and if you're an agent, when you've done your bargain, right, when you fulfill recognized revenue, when its performance obligation to arrange for the specified goods or services is complete. You may not have yet transferred, but your obligation is you've got the buyer and the seller to come together, and now you are entitled for your commission. If that been the case, you're supposed to record revenue, even though the seller maybe or yet is required to fulfill its performance obligation, right? So you got to, of course, be mindful of some of these contractual arrangements, but more likely than not, you'll be able to record revenue or demonstrate that all the revenue recognition criteria are fulfilled. Okay, let's take this example of a travel agent. A travel company negotiates with major airlines to obtain access to airline tickets at reduced rates and sells the tickets to its customer through its website. Travel company contract with the airline to buy a specific number of tickets at agreed upon rates and must pay for those tickets regardless of whether it is able to resell them, right? So I'm already buying a block of tickets, right? And I have to pay whether, even though I may not be able to resell it. Customers visiting Travelco website search Travelco available tickets. Travelco has discretion in establishing prices for the tickets it sells to its customer. Now, the Travelco is responsible for delivery of the ticket. Travelco will also assist the customer in resolving any grievances. The airline is responsible for fulfilling all other obligations, of course, to fly the airplane. That's not the Travelco responsibility. That's the responsibility of the airline, right? Now, the question here is the Travelco the principal or the agent, right? Remember the three criteria that who is primary obliger in a way, who is responsible for fulfillment of performance obligation, who has the inventory risk, right? I'm taking the inventory risk, and then who has the price latitude, so to say price risk, right? I can decide at what price point I want to sell, from. So am I the principal or am I the agent in this arrangement? So let's look at our solution. So Travelco is the principal, right? Why principal? Because I am delivering what promises I'm making to provide you a ticket. I'm also taking care of grievances. And so I'm not doing the flying, right, for, which is the intended purpose of you buying, but I'm helping you with some elements of that performance obligation. I'm certainly taking the inventory risk in this example, because if I'm not able to resell, it's actually lost to me, right? And those seats are going to go then vacant, right? And then the third is I am free to decide to sell at what price point I want to sell, right? So Travelco has the ability to direct the use of the ticket and obtains the remaining benefit from the ticket by reselling the ticket. I have the inventory risk, and in a way indicator supports that the Travelco is the principal in this arrangement, right? So I've taken the title of this inventory, and then I do transfer the inventory to whosoever I wish to transfer, from that perspective, and hence I am the principal in this arrangement. So many a times we see this across the board, as I talked about, many other arrangements like aggregators, like insurance agents, like the thing is that for you to actually look at any transaction and say, is your capital is at risk? The moment the question of inventory comes in, that the whole question is your capital is at risk for the type of transaction you are doing. And that's where you saw, let's say the transfer of title is momentarily, right? It just happens and then you immediately transfer, right? It's like back-to-back arrangements, right? So if they're back-to-back arrangement, again, you got to look at it very, very carefully, right? If they're back-to-back arrangements, there is am I taking a capital risk? Am I taking an inventory? What is going to happen if the other party going to back out, right? Will I have the ability to then give it back at the same price, or no, I will be left exposed, from that perspective. So some of those business terms, the trade practices at times becomes important for us to determine. In majority of the cases, again, it will be simple for you to assess that am I the principal, am I the agent? If you're the principal, the benefit of you being the principal, you got to record revenue on a gross basis. If you're an agent, you record revenue on a net basis, so on and so forth perspective. Okay, let's move forward to talk about consignment arrangements, right? Now, what are consignment arrangements? So when you look at a buyer and a seller, right, that you're selling goods to a counterparty, there's a transfer of risk and reward. When you think of a consignment arrangement, there is a consigner and a consignee. In a consignment arrangement, who do we have? There is a consigner, right, and there is a consignee. Actually, there's no buyer here, right? The buyer is actually to come at the subsequent stage, right? And that's the whole question. Is the consignee is the buyer, or consignee is nothing but your extension? Consignee is nothing but your extension, from that perspective. So a consignment agreement is an agreement between a consignee and a consigner for the storage, transfer, sale, or resale and use of the goods. The consignee may take goods from the consignment stock for use or resale, subject to payment to the consigner, agreeably to the terms bargained in the consignment arrangement. Entities frequently deliver inventory on a consignment basis to other parties like distributor or dealers. Now, there are following indicators. The product is controlled by the entity, which is the primary party. The entity is able to require the return of the product. The dealer does not have an unconditional obligation to pay for the product, right? So again, it is controlled by the entity. The entity is able to require the return of the product. The dealer does not have an unconditional obligation, or it can transfer the product to a third party, such as another dealer in a way. So essentially, the consignee or maybe the ultimate end user, they're still not the owner of those goods. They're still not having the risk and rewards of those goods till the time actually there is a transfer of those risk and reward. It is not a criteria for revenue recognition. So revenue is not recognized when the goods are delivered to the consignee if control of the inventory has not been transferred. Okay, let's look at this as an example. Manufacturer M enters into a 60-day consignment contract to ship 1,000 dresses to retailer A store. So I'm shipping 1,000 dresses to retailer A. Now, retailer A is obligated to pay manufacturer M INR 20 per dress when the dress is sold to an end customer, right? So retailer A is obligated to pay manufacturer M INR 20 when? Only when it is sold to an end customer. Otherwise, I am not going to pay, okay? Otherwise, it's your stock. Take it away, right? Now, during the consignment period, manufacturer M has the contractual right to require retailer A to either return or transfer them to another retailer, right? Manufacturer M is also required to accept the return of the inventory. Okay. So the question is, when exactly is the control transferred, right? Now the control is only presumed to be transferred in this when actually there is a sale, right? Which is sale by the retailer to the end customer. Then only, you're taking it and then you're giving it, right? Before that, it is not a sale in a way, because the manufacturer is still retaining all the risk and reward. If there are no customers, you will have to get the goods returned. So there is no transfer of risk and reward. Now, manufacturer M determines that the control has not been transferred to retailer A on delivery for the following reasons. Retailer A does not have an unconditional obligation to pay for the dresses until they have been sold to an end customer. Manufacturer M is able to direct the goods to be transferred to another retailer at any time before the retailer A sells them. Manufacturer M is able to also require the return of the dresser, right? So in a way, this is what a consignment arrangement is. So you will record revenue when they are sold to the end customer. All right. You will not record revenue just because I've shipped these goods to the retailer, because I, as a supplier or manufacturer, I haven't transferred the risk and reward. Hence, the earning process is not complete. Because the earning process is not complete, you're not supposed to record revenue. Let's look at another types of arrangement, like long-term arrangements. Okay. Now, when we think about a long-term arrangement, like a 3-year arrangement or a 5-year arrangement, 2-year arrangement, generally anything which goes beyond 1 year. So entities frequently enter into arrangements to provide services on a long-term basis, such as maintenance services, right? Should a 3-year maintenance agreement be considered as a single performance obligation representing the entire contractual period, or should it be broken into smaller, like daily, weekly, monthly, yearly, half yearly kind of stuff, right? Now that is where the series of distinct performance obligation comes in, right? In a way, it may be appropriate to treat a 3-year service contract as 3 separate 1-year performance obligation if the contract can be renewed or cancelled by either party at discrete point in time. If they can terminate it, right? If they can terminate it, the entity would separately account for its rights and obligation for each period in which contract cannot be cancelled by the other party, right? So you have to again look at the cancellation or renewals for you to determine the duration of the contract. We talked about this in the context of the identify the contract with the customer, right? In long-term service arrangements, right? In long-term service arrangement, um, in long-term service arrangement, let me just correct this. Yeah, in long-term service arrangements, right? When the consideration is fixed, the accounting generally will not change, regardless of whether a single performance obligation or maintenance or multiple performance obligation. Why the accounting will not change? Because you end up doing straight line method of revenue recognition. Straight line method of revenue recognition, right? That is why the accounting generally do not change. The answer will not change. Let's look at this example. A cable company, right? A cable company provides television services for a fixed rate fee of INR 800 per month for a period of 3 years. Now, cable services is satisfied over time because customer consumes and receives benefit from services as it is provided. Customer generally benefits each day and they have access to the cables every day, right? I am benefiting, right? How many performance obligation does the cable company have, right? So one can argue over a 3-year period every day, right? Cable company determines that each increment of service, day or month, is a distinct performance obligation, because customer can benefit and from that of its own, right? I may decide to watch television today, not decide to watch it tomorrow, but I still have to pay 800 rupees, right, per month. That means as a service provider, I'm stand ready to perform. As a recipient, I want to benefit if I want to consume the services. So each increment of service is separately identifiable. However, okay, So there are series of single performance obligation, right? There's a single series of performance obligation, right? Each of the distinct increment of service is satisfied over time, right? And then you got to record revenue basis the regardless of the contract. As cable company uses the same measure of progress, essentially what does it mean? You'll end up recording revenue on a straight line basis over the contract period, right? So whether you treat it as 1 day or a 30-day or a 1 year, your revenue recognition will not change. Okay, let's now look at last type of scenario we have here on non-refundable upfront fees, right? So the question here is, let's say you go and take a membership of a gym, right? Or you go take a membership of a health club, for example, right? Or you do a magazine subscription, right? For example, and then you paid for next 12 months on day zero that I'm going to pay, let's say 30,000 rupees or 30,000 rupees or 5,000 rupees, whatever is the contract consideration for getting into that service. The whole question is that, do I record that 5,000 as revenue upfront? Or I'm going to record that 5,000 as revenue over the performance period, And the other question is that if I've received this money, is this actually a revenue? Is this results into a culmination of an earning process? Have I fulfilled a performance obligation, right? If I haven't fulfilled a performance obligation, then you are not supposed to record the revenue, right? So let's look at the scenario. An entity charges the customer a refundable upfront fee in few contracts. Example like joining a health club membership, or activation fee, or a setup fee in certain service contract, initial fee or joining fee in some supply contract, etc. Right? Now we got to identify the performance obligation in such contract. You should assess whether the fee relate to an activity that the entity is required to undertake at the inception of the contract, or that activity does not result into the transfer of promised goods or services to the customer. And if the non-refundable upfront fee relates to a good or service, the entity shall evaluate whether there is a separate performance obligation. So you got to evaluate that whether it's a separate performance obligation. And many a time you may charge a non-refundable fee as part of the compensation of cost incurred in setting up a contract. These setup activities do not satisfy a performance obligation. You will disregard those activities because the cost of setup activities do not depict transfer of services to the customer. Now, this is again an area of judgment, right? That whether the setup activity constitute a separate performance obligation or they are not to be considered as a separate performance. So question you have to evaluate, that I as a customer, am I going to benefit because of this? I was looking at these setup activities, or actually I'm going to actually benefit when I start consuming the services, right? So that's an element, which is often we see what call as activation fees. More often than not, activation fees are not considered to be a separate performance obligation. And then they are subsumed into the main performance obligation, and whatever money you've received on account of activation fee, that is to be recorded over the period of the performance obligation. We will try and understand this, with the help of an example. So customer buy a new data connection from the telecom entity. It pays one-time registration and activation fee at the time of purchase of new connection. One-time activation. The customer will be charged based on the usage of the data services. So why you're buying actually? You're buying for the purpose of usage of data, right? You're not buying for activation. Activation is you're not getting anything by activation. You actually, once you start consuming, then you will start benefiting, right? So are the performance obligation under the contract distinct, right? And that's where when you look at the analysis, by selling a new connection, the entity's promises to provide the data services, the activation in itself is not a separate performance obligation. The activity of registering and activating connection is not a service to customer, therefore does not represent satisfaction of a performance obligation. So entity obligation is to provide the provide data services, and hence activation is not a separate performance obligation. All right. And then when you record this activation fee over the fulfillment of the performance obligation, we'll talk a lot more, in terms of the recognition criteria. So quickly, in a way, summarizing what we've in a way talked about, some of the things on principal versus agent. So when you are a principal, when you are an agent, is something what you need to be careful about, right? And who's the principal is somebody who's responsible, taking a primary obliger role, responsible for fulfillment of performance obligation. You're taking the inventory risk, and you have the latitude in establishing pricing. If you fulfill this, you record revenue on a gross basis, otherwise you record revenue on a net basis. Then we talked about the consignment arrangements. Are you a consigner or a consignee? In a consigner and consignee arrangement, you record revenue when there's a transfer of risk and reward from the consignor to the consignee, or to maybe a end customer, if there is an end customer. So again, it's an area of judgment, and you got to be careful about this. Similarly, on a non-refundable upfront fee, the question we often struggle is this resulting into a revenue recognition? Is this a separate performance obligation? And that's where an activation fee more often than not will be not considered as a separate performance obligation, and hence you will end up recording this money as revenue over a period of time of the activity, which is to be considered as a separate performance obligation, like activation fee, like membership fee and all. Similarly, on long-term arrangements, which you enter into with a customer, you got to determine the unit of account. Are there a series of distinct performance obligation? If answer to that is yes, you will consider them as separate performance obligation, record revenue again largely on a straight line basis over a period of time, and hence whether you take 1 day, 2 day, 100 day, but if there are termination clauses, then that results into a termination and entering into a new customer contract. And you remember we talked about this in our example on customer modification as well, which resulted into a change in the customer contract, right? Whether the modification results into a creation of a new contract or continuation of an existing contract. And we saw in the example of a maintenance that if you decide to terminate the maintenance after a 6-month period and then renew on new terms, in a way that was considered the termination of an existing relationship and the commencement of a new relationship from that perspective. So all of this, again, there are elements of judgment is what you need to think through, what you need to be careful about, and then apply it appropriately from the perspective of revenue recognition. Now we're going to move and talk about step 3 on determining the transaction price. And I'm going to take a pause here. Thank you.